The two biggest questions in money today: is it too late to buy stocks, or is it time to get out? Unstoppable or frothy? You know what? It's beside the point. Trying to pick highs and lows, market timing as it's known, that's best left to the professionals. For the rest of us, some simple rules can take the anxiety out of the what to do questions when stock markets are really moving. First, know your risk. The younger you are, the more of your retirement portfolio should be in stocks. From 25 to 35 years old, you can load up on stocks. You have a very high risk tolerance in this age group. But by 55, it's an entirely different story. You should lighten up on stocks and have a blend of stocks, bonds, cash, real estate, and alternative investments. This is called asset allocation, and you know what? It will change over time, from risky when you're young to more conservative. Which brings me to rebalancing. Especially when stocks are red hot, your asset allocation can get out of whack. You need to periodically rebalance your portfolio, trimming here, adding there, to keep the portfolio appropriate for your age and risk. Now, in many 401k plans, you can set this to be automatic, rebalancing quarterly or annually. Set it and forget it. Now, speaking of automatic, the best way to ride markets up and down, frankly, is to buy stocks at regular intervals, whether they are rising or falling. Dollar cost averaging smooths out the risk over time. Now, if you're intent on buying and selling individual stocks, fine. Make sure you're playing with money you can afford to lose. It's called risk capital. Intimidated by the stock market? Well, consider legendary investor Warren Buffett's advice. Buy a low-cost index fund tracking the S&P 500. Ignore peaks, ignore valleys, ignore the business headlines, and consistently add to your stocks until you're near retirement.